from it. So
Right,
no
right.
harm in recording.
Yeah,
Yeah.
yeah, makes sense. Makes absolute sense. Um, so my journey with derivatives has been since I think January this year, and what took me to derivatives was it was a hedging. I mean, I thought of it in terms of hedging because many times we purchase, say, a stock, we think that this is the fair value of the stock, but the market, in its all wisdom, does not think that's the fair value. It would pull it down. Maybe one of the stock, both Nirvan and me, we are looking at, say, for example, Krishna Diagnostics, right? If I look at the 1 day chart, it has been getting sold off incessantly, although the business is not, I mean it's, I won't say it's rotten, it's still good. I mean, there's no not so much of bad news. There's just one bad news of an IT raid, but then that's not relevant. I mean, we feel that that's not relevant, but it shouldn't be getting such negative sentiment and all. So today it also dropped 5%, right? So many times what happens is, say you feel this is a good zone because you see think that, say, some sort of a support is getting created because, say, Krishna was in this zone for almost, I think, 3 4 months, right? Somebody takes a position and then it falls all the way down here, right? What is a good way to hedge yourself, or what is a good way to say that if the company falls this way, um, I get back some part of the money? It's something like an insurance, right? So say for example you're buying TCS, and let me take TCS again here. So TCS was going. I mean, I made a channel. It was following the channel, and suddenly it started falling. It started falling because Nasdaq was falling. So TCS is highly linked to how the US economy is. So since Nasdaq was falling, TCS started to fall, and say an investor who felt, I mean, TCS was anyways underperforming for some time. This was a, I mean, this was some sort of a resistance. If you see, if you understand the concept of resistance, anybody understands it, or any guesses what could be a resistance?
That investors are trying to sell at that particular point, there is selling pressure.
Yes, correct, correct. Even I understand it that way. And there's a support. So this is where lots of people are buying. So
Yes,
so
yes,
yeah,
opposite of that exact.
yes. So a large majority of people would probably think this is the fair value of the security, and a large people percentage of people will think this is not the fair value. This is probably overpriced, right? And there's a huge differential. I mean, think about it. This is almost 3,000, and this is 3,040. So there's a 10%, I mean, upside. So anybody can do swing trading and all of those things over here, right? um, what was happening is this kind of broke this channel, and it was kind of going up, 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 and suddenly it started dropping. As an investor who doesn't have all the resources and all of those things, maybe you were doing an SIP from over here, how could you protect yourself? So that was one of the main question which I went that was what was haunting me. And so one of the ways by which you can do is derivatives. Now derivatives are like taking insurance policies. Like you have your health insurance, right? You pay a premium to the insurance company, say 1,000 rupees, and the insurance company insures your health, or insures your health expenditures for the next, say, 1 year by, say, 10 lakh rupees. So you have a deadline of 1 year. Your premium is, say, 1,000 or 10,000, whichever it could be, 1%, 2% of the entire premium amount or entire liability amount. And there is also a deadline of, I mean, strike price, which deadline, yeah. So that was why I got into these things. And as I went deeper into it, what felt or what I understood was, unlike the stock market where there's a direction, I mean, you can make money either going, either being right, and you're being right before most other people. So say you're right at this position, and then lots of people became right, and then the stock price came up here. Or you could make money by selling over here, shorting, and then carrying over the trade over longer periods of time. So you sell today and then you buy at the end of the market. Again, you sell tomorrow, buy at the end of the market. In Indian markets, we can't carry over our trades in the directional way. So you can't have a long term view. So you can't say, I expect that in the next 1 month, TCS would be down, say, 50 60%. So you can't have something like that. You have to do it every day. So you will have to incur brokerage charges and all sorts of things, right? And you will also have to engage, I mean, you will also be taxed at every situation, so every point. So the money that you make, a large amount of it would be taxed out. So that's one challenge. um, an alternate solution to this is derivatives. Now, anybody has idea other than Rishikesh? I think Rishikesh, you have a fair amount of idea about derivatives. Other than Rishikesh, anybody? And Nirvan, of course. Any three of you have any idea? Tanvi, did you read derivatives in your college? Uh,
Yeah, like futures or forwards,
Options,
options, swaps.
right? So, do you understand it?
Yeah, I have
Great. So,
understanding.
so I will try to use a tool that I use, a Sensible. Um, Basically, what do I do now? You can have many instruments, but generally Nifty and Bank Nifty are the most liquid forms of these FNO stocks, option stocks. Now I don't understand futures that good, but I've started to understand options, and options is basically, how do you say it? So basically, if you look at this payoff graph, right? Nifty today is at how much? It's at 17,392, right? Um, and you have a expiry day. So basically, if I had purchased this call option, what would happen is I expect, or the seller of the option, he ensures that by 2nd of March, if Nifty goes say above, say 5 10 1%, if Nifty goes above 1%, which is very low, it's not high, he would pay me 5,000 rupees, something like that. So he would pay me the equal amount of money that it goes up above my strike price, which is at say 17,400, right? Similarly, I can have a put option. So if I expect that Nifty will go down, I can purchase this option from a option seller, which costs me around 3,000 rupees. But if Nifty is in a bearish condition, I mean, if people are shorting it like crazy, I can make a huge sum of money. I can make unlimited profit, but my loss is also unlimited. I mean, just capped to 100%. So that's the point of view of the buyer. So the buyer has limited losses but unlimited potential for profit. And now let's look at the condition of a seller. Now, if I were a seller, right? Nifty again is at 17,400 over here. Uh, just a sec. Yeah, something 17,400. Now I sell this short call option, expecting that Nifty will not go further down, because in case Nifty goes down, I will have unlimited losses because I have to pay to the buyer who has bought the call option at 17,400, right? So that is the entire play, and you can build up strategies like anything. So for example, my favorite strategy is this iron condor. What I usually do, sorry, I'll just put a 9th March, it will be more visible. Yeah, what I usually do is I try to predict how Nifty would move, looking at say many things such as open interest and all, and take and taking that view, I try to put up this. It's called a iron condor. A condor is like a bird. If by the end of 9th of March, which is the strike price date, I am inside this green zone, then I make say 8% on the capital that is taken. I mean, that's kept as margin. It's a net credit sort of a strategy. So I get paid. There are net debit where you have to pay. So that's how derivatives kind of operate. It's a complex thing. It has lots of variables. Time, for example, there's this Greeks which are inputs to the option pricing. So you have delta, the rate at which the premium is shifting, divided by the underlying, the velocity of the underlying. So basically, it tells you how fast your option price will move based on the movement of Nifty. Theta is the rate of, I mean, the rate at which you're going to, or your options will be priced based on time spent. So basically every day there is some amount of, what do you call it? Okay, I got confused between theta and decay. Yeah, so change in your profit and loss after one day if nothing else changes. Your decay is time value. So basically if nothing again changes, how much you will get. I think I don't understand decay so well. Gamma is the acceleration. So basically how fast is this Nifty moving towards it? Because if you have a large movement, then the option prices fall down, or it might rise. So for example, sell option might rise, and vega is the volatility. So these are some of the parameters that go into option pricing, and based on that pricing, my payoff graph starts moving. So basically if I have a lot of volatility like we had in the last few days, I increase my volatility, my options become more expensive. So in a net credit sort of a system, I actually get 3,000, 3,000 rupees or 3,725 from the buyer of these options. So I sold this call options and I bought this call and put options. I get 3,000 rupees back. If the option prices go up because of increase of IV, so basically there's a huge amount of volatility. Nifty is falling down from India VIX and all. Your prices of this call options shoot up, and due to that, what happens is you can't sell it cheap. So my goal when I'm into this kind of strategy is I try to sell high and then purchase the same option at a lower price. So basically, if I maybe show it with a put option, yeah. So put is basically when your Nifty is going down on the negative side, yeah, something like that. It's a bit non-intuitive. It took me a lot of time to understand, but yeah. So for example, if I what do? I try to show you with respect to yeah, how will I make profit? So today put is at, say for example, it's at 114 rupees, right? And that's for one lot. If what I expect is in the next, say, few days, the put option will actually become lesser priced, so I will make more profit because I today I bought it at 104 or I sold it at 114. As the option goes near to its expiry, I will be able to sell it off at a lesser price and thereby making the profit. So that's the general idea. Any question? Because I think I've been speaking a lot, and many things might go
Yeah,
off my
Gaurav,
head.
one question from my side. So I think it would be useful if you can, if it's possible, to
Huh.
explain the basics of the payoff of a call option, put option,
Hmm.
using one example, strike price. I think that will
Perfect. Yeah.
basically clarify some concepts, because I
Let's
think
do
for
it.
people who haven't heard of those, now this that will make it easier to understand.
Absolutely. Yeah, that's a good feedback. Let's do it
Yeah.
with this one. So basically, let's today's condition. Today Nifty is at 17,392. Uh, this, if you would have bought this call option at 3:30 at night, I mean just before the market closed, this would have been your payoff. Basically, you put in or you purchase this call option for 11,000 rupees. This option expires on 16th March. So basically, there are 16 days to expiry, right? And why will you buy this option? You are expecting, most likely you are expecting Nifty to go up, say a percentage, 2%, something like that in the next few days, which is reasonable, right? Because Nifty has fallen so much. So you expect Nifty to go up by 2% in the next few days. Um, in that case, what would happen is you would eventually make almost 124% of the profit. So basically, if you are correct, if your prediction is correct, you could make almost double the amount. And that's one of the reason most people actually buy call option, expecting the underlying to either go up and go down. This is the payoff diagram. If Nifty doesn't move up, you're going to lose the entire money. So if Nifty goes down, you're going to lose as per this blue line. So say for example, it's going down 5%. So at today's price, you will lose only 429. But call options are a depreciating asset. So basically, if you think of it like this, say I am say there's an insurance company. The insurance company is selling you an insurance for a year versus a month. So the insurance amount for the month would be much less compared to a year, because the amount of risk that he's taking by selling you an insurance for a year is much larger. So options have the same thing. The seller of the option who's selling this option, he's taking far more risk by selling an option, or by selling an option with a strike date of almost 16 March, which is again 16 days from today. He's taking much more risk. So that's why he charges more premium. And that is why one of the reason your break even is also very far. So when you buy an option at say, for example, 17,400, don't expect you to make money just immediately. It might break even after a little bit of time. So that's the general idea. Yeah. Any question on this one?
So, Gaurav, just to understand this particular call option, so you're
Hmm.
saying that this is a call option with an expiry on 16th March, and
Hmm.
the strike price is 17,400, right?
Correct.
And what is the Nifty value today?
Nifty value is 17,392. That's on top over here.
17,392. Okay, so today Nifty is at 17,392, and I
Hmm.
want to make a bet. So if I'm a call option buyer, I am basically saying that if I'm trying to buy a call option at 17,400, I am basically betting that Nifty will be higher than 17,400 on 16th March. Is that correct?
Not just higher than 16,400. You have to break. I mean, so you,
Correct.
yeah, plus the amount of money that you have given.
Plus the amount of money that I've paid to buy
Correct.
the option. So basically,
Correct.
221 rupees I have already spent to buy this call option
Yes.
on Nifty. So
Yes.
if my Nifty moves up by 221 by 16th March, then I will break even.
Correct. Correct. So this is the break-even amount.
Right.
It needs to go 1.3% for you to break even.
1.3%. Okay.
And this 220 is the price per option. So options are traded in lots. So
Lots.
each lot
Okay.
has 50
I see.
call.
I see.
So that's why it's 11,000.
It's 11,000. Okay.
So the net bet that you're taking is of 11,000,
11,000.
and it will break even at 17 to 621.
17,621. Okay. So
Yes.
basically, if it doesn't reach 17,621, if it is somewhere between 17,392, which is today's Nifty value, and between 17,621, I will recover some money that I've paid out, but not all. That's right.
Correct.
Right.
Also, again, options. I mean, as I told you, in option pricing, there are multiple parameters that go, which are the Greeks. But then for the buyer of the call option, I think the biggest parameter or the biggest enemy is time. So
Right.
theta or theta decay is the biggest. So at today's date,
Right.
it's going to lose 359 rupees if nothing else happens.
Right.
Right. Again, volatility is their best friend, because if there is
Correct.
volatility in the market, then their prices would go up.
Correct.
So basically the option pricing, because the seller would demand for much larger premium,
Yeah.
and you have already bought something at a lower premium, so you can sell it higher and get out of it.
Correct. Got it. Okay.
Could you please explain again how the concept of time decay, theta decay, works here?
Okay, let's think of it like this. If say you and me, I'm the seller and you're the buyer, right? And we are in the same situation. 16th March, strike price at 17,400, right? And price of it is 220.95, right?
Yeah.
Now you the original condition is 16th March. Say for example, you feel like you probably need a little larger time. You put the or you want a strike price of say end of April, right? 30th April. Okay. From my point of view, am I taking more risk or less risk?
More.
I'm taking more risk, so that's why I'm going to take more premium, isn't it?
Yes.
Right. So let's go to then 30th or end of April. So basically over here. So you see, I'm taking almost double the premium from you, right? Yeah, because I expect, I mean, I'm taking more risk. I don't want you, I mean, it might go, it might not go, who knows, right? So now what happens is every day that I spend or every day that passes, the expiry comes near. So a 27th April is today at 58 days to expiry, but say for example, almost 20 days has passed, it will come very closer to expiry, right? So the option seller at that point will not charge the previous amount, because now days to expiry has reduced, and this is more of an exponential curve. So if I try to show you, 1 second, just a second, there's where I read it from. So just yo.
This is Zerodha Varsity. It's a very good resource.
Yeah, this is amazing.
Yeah, so much free content.
Yeah, but the only challenge is they don't have I mean the real part. This is all good. It gives you starter.
This is the theory, this is the theory.
But if you read this and go, you are going to lose money. Sure.
Yeah.
Okay, so how does option premium kind of decay with time? So basically at 120 days, your option price was almost 350, for example. But as time passes, it decays in an exponential manner. And especially at the end of it, I mean, say, for example, 20 days left or 15 days left or just 5 days left, it decays like anything. Every day you have a very large decay, 1%, 2% decay at the end of it in near expiry, right? Because at near expiry, the option seller, I mean, for the option seller, they almost know that, the option is going to expire worthless. And for the option buyer, they don't want to pay so much because they also think, the market is not going to move so much. So that's why the decay rate falls down.
So
Right.
Gaurav, I just thought of one simple way of trying to explain this. Can I take a shot at it?
Yes, please.
So-
Yes, please.
Yeah. So Shantanu, so basically when you're buying a call option, okay, so you are saying that I am going to buy, say, a call option for the Nifty for the same call option, 17,400 for some price X for say 200 rupees. Okay. So if the call option goes up, if the Nifty value keeps going up, you will make more and more profit because you have the right to buy that option at 17,400, whereas say Nifty finishes at 18,000, you capture that gain of 18,000 minus 17,400 minus whatever you paid to buy the option, right? But so basically on the upside, your payoff can go to an infinite amount, okay, provided the Nifty keeps going up. But on the downside, your losses are actually capped because if the Nifty ends below 17,400, you just lose whatever money you paid to buy the option. You don't make any additional losses.
Understood.
Okay, so the payoff diagram is basically, it's called a payoff diagram, that below the cutoff price, below the exercise price, the 17,400 is called an exercise price. Your loss is capped at whatever you have already paid, and beyond that, your profit is infinite. Okay, so now if there is more time remaining for the option to expire, yeah, suppose there is 3 months remaining, then in 3 months a war can happen, a great technology can get unearthed, so the stock can move, stock, or in this case the index, has equal probability of moving up, down, anywhere, right? But the payoff is structured in such a way that even if it moves down and becomes zero, you don't lose any additional amount. But if it moves up and becomes infinite, you capture all that gain, right? So from an option holder's point of view, time has huge value because time can make the stock go up and down both. But if it goes down, you don't lose anything. If it goes up, you only gain. So as this time decays and it comes closer to expiry, the number of things that can happen to that stock gets limited because 2 दिन में जितना होगा 1 साल में उससे ज्यादा होगा, right? So,
Yeah.
so that is how I understand time decay and the value of time decay for somebody who's holding an option.
Understood.
And similarly, I think Gaurav, for volatility, I think which one is it? Is it Vega, right? The volatility.
Vega. Yes,
Vega,
yes,
yeah,
yes.
yeah. So Vega is basically how much does the price of an option change with a unit change in volatility. Volatility is how volatile is Nifty. You know, the standard deviation of the returns of Nifty over say 30 days, 100 days, or whatever. So if there is more volatility, think of it in the same way. It can again move up and move down. But in one side, your losses are capped. In one side, your gains are infinite. So the more the volatility, the more options are valuable, because options have a non-symmetric payoff. They have payoff only in one direction.
Now,
So
you can also think of volatility something like this. Volatility is the measure of fear in the market.
right.
So uncertainties of the market. So from the option seller point of view, say again, we take the example of a insurance company, health insurance company. They are coming into, say, they're selling insurances in the month of, say, December in Delhi, right? Delhi has a lot of smoke. There's firecracker and all of those things. Most likely, there would be lots of people who will fall sick, right? So in those cases, they will charge higher premium because else if they don't, if more people fall sick, they'll lose a lot of money from insurance payouts. So something like that. In case of say for example, you're an option seller and there is a situation that there might be some war or some civil war that is happening, might happen, something that is happening. Would you charge less? Of course not. You'll probably also factor that risk in, and this is what volatility brings into the entire equation. So but volatility is a very skewed metric because when the prices fall down, your volatility increases, but when the prices go up, your volatility reduces. And that is what makes it a bit confusing also. Many people who try to trade volatility kind of get stuck in this part. So you should be careful what is happening with the market. So that's another thing. One thing that I can show is what I was doing yesterday. This is a very tricky sort of a thing. Example. So a couple of weeks back, my options were sort of in this position. So I had a projected loss of 4,600. I had like 3 lots, and I was probably going to lose like around 17,000 rupees if the Nifty would have crossed. It actually crossed and then it went back. Right. I had a mark to market. So in that day, I had a loss of 14,600. So something like this. So
Interesting.
I would and basically this entire payoff diagram, this can come out with the strategy that you're using. So there are multiple strategy that you could do. Okay.
So on that, Gaurav, for the strategy that you normally use, the iron condor strategy,
Mm.
can you explain, like, so for example, these lines, right? These are a
Mm.
combination of multiple payoff diagrams, I assume, right?
Correct.
Because of multiple options you're holding. So can you explain this? Because earlier also when you tried to explain, I wasn't able to, understand. So this time I would really like to understand this. So how do you like, how does this, what
All right.
combination of calls and puts is creating this particular structure?
Let's talk it like this one. Okay. First, I choose the strike date. Okay.
Hmm.
It's 9th of March. It's all in my head. Just that I'm unable to express it
No,
nicely.
it's not your
Very-
inability to express. I wasn't able to absorb it. Today I'll
No,
like
no.
ask questions and make sure I
Perfect.
understand.
Good. Okay. So what I do is I sell a call option. Basically, I sell a put option first, or maybe a call
Mhm.
option. Any of that. So I sell a
Mhm.
call and a put. So this is basically a strangle. It's called a strangle. What it does is, say my Nifty is at, where is Nifty? Okay, put Nifty over there. So my Nifty is at say 17,300. So basically, I take a strike price 17,400. I go 200 points this side on the negative side and 200
Hmm.
points on the positive side. I
Okay.
sell to call option. This call option gives me a potential profit of 6% and a loss, unlimited loss.
So
Right?
you sell a call option with a strike price of 17,600.
Yeah, one is at seven. The call option is sold at 17,600, and the put
Hmm.
option is sold at 17,200.
So let me, I mean, I'm, because I don't work
Hmm.
with options, it's very complicated for me. So let me spell it out. So it means that for the call option that you're selling for 17,600,
Hmm.
if the index goes above 17,600, you make a
Hmm.
loss.
Correct.
Correct?
No,
And
just a second.
yeah,
Not just 17,600,
plus 75,
17,600
plus
plus the
75.
premium that I'm
That's the
taking.
premium
Yes.
that I've already captured by selling it to somebody, right?
Correct.
So if it goes above 17,675, then I start making a loss.
Correct.
Correct. And for the put option, I have again sold a put option, which means I'm long the stock. So if the stock goes below 17,147, again I start making a loss.
Correct. Exactly.
Okay.
Perfect.
And anything in between, I make profits in both strategies, right?
Both strategies, yes.
Right.
So basically,
Okay.
that's why I cap it. Else, what you can do, I mean, what if you don't cap it? What would happen is, say, for example, you have a directional view. Now, a
Hmm.
directional view is very dangerous in the market.
Yeah.
One of the reason why a directional view is dangerous is if you are incorrect, you might
Yeah.
lose heavy.
You might lose
So
heavy.
yeah, so that's why, and also it helps you adjust faster if you don't have a directional view in the market.
But in a directional market, if I buy a call option, okay,
Hmm.
then I will only lose my premium that I've paid, right? Maximum. I mean,
Yes.
right?
Yes.
So I can gain on the upside, but my loss is capped at the premium.
Yes, but Nirvan, another statistics is 90% of options expire worthless.
Okay. That I didn't
90%
know.
of options expire worthless.
Okay.
Now I'll try to come from the institution point of view. The
Hmm.
people who make money, see, option is a net zero game. So
Yeah.
somebody losing money, somebody will win money, and the government will collect 25% tax from
Yeah.
the winner. So government and NSE is the winner.
Yeah.
Other than that, whoever,
And Angel One is also the winner. I mean,
yeah,
Sirodha
Angel,
Angel One. Yeah.
whoever, yeah, broker,
Yeah.
it's the 20 rupees. That's not hard much, but still, it's a winner.
Yeah.
Yeah, but whoever is kind of, just a sec, yeah. Uh, what was I explaining? Yeah, from the institution's point of view, let me try to explain it.
Hmm.
So a lot of people, a lot of retail investor, what they do is they think like us. Nifty will go up 1%, Nifty will go down 2%, and they'll buy a option. They'll buy a option, and they'll buy when you're buying an option. Say for example, I'll try to take another one. Or maybe you remember, right? If you're just buying a call option, even for 9th March,
Yeah.
it's going to cost you 1,300.
Right.
So they feel like it's not so much. So let me buy it because there's unlimited profit potential once
Right.
I go up. And
Right.
it actually does. I was doing a day trading for a couple of, I mean, one day I tried day trading with options. I put up 30,000 rupees and I made 20,000 rupees out of it. I posted it on Twitter as well. Okay. I
Right.
was just doing day trading, right?
Yeah.
So you can leverage win. And then the next day I was also doing day trading and I lost 20,000 rupees. So it can go either way. It's a double-edged sword because you're leveraging it. So you're buying an option and it goes down, it goes down and it kills you. If it goes up, you make a lot of money. Yeah, something like that. So now, as I was saying, so retail investors or generally retail investors, they are net buyers of the option because they look at it as a lottery. Okay. Whereas big institutions, they are net sellers of the option. What you
Right.
see over here, this dark, this green and the red line, the red lines are OI, open interest. So open interest is the amount of options that is placed at that position. So amount of call options or put option, right? So if you see at 17,410, 17,520, 17,620, there's a huge amount of call option. What call option does is, from an institution point of view, the institutions do not expect the market to go above it. Let me take you to the open interest chain first. So if you look over here, there's an open interest of 7.1 million. Okay, now imagine this is for, let's say, next month's this thing. So 600,000 call option is present, and almost 480,000 put option is present at this position, right? And you see the call option numbers are so large.
These are
Uh,
long call options.
these are for next week's expiry, so 9th March expiry.
Right. So these are buy call options, right? Like long calls.
No, long calls means you're buying the call. These are shots.
These are short calls. Okay.
I
Okay.
mean, for each of them there would be a buy and a sell, na?
Right. Right. Ha. Right. Right. So these are the
Right.
number of open options. Sorry. Sorry.
Number of options that has been written at
Right.
these positions.
Right.
So when you see a large amount of call option at a certain location, generally because writing a call option needs you to have a large what you call margin. So basically, if I need to write a call option, let me take you to strategy builder again. So if I yeah, if I need to write a, say, a sell option, I'm writing a call option or a put option maybe.
Premium is
Uh,
very high.
the premium goes to 86,000, right? So it's very large. Such large money is not available. I mean, generally retail investors don't have it.
Got it.
Even who's trading, I mean, it's a very large money. So call is like Dravi. I mean, if you're playing like as a call, you're selling call options, you're kind of playing on the defensive. But if you're playing on the offensive as a buyer, there is high potential to win, but then there is also, I mean, you might lose your entire capital as well.
Your entire capital. Okay.
Yeah.
Got it. So
So
basically what you're saying is if there is a high call open interest at some price level, that is probably institutional level call selling, and that might be high probability of where Nifty doesn't breach that level, right?
correct. Because what happens is on Wednesday and Thursday before the expiry, these institutions which short it like anything, they'll short Nifty, they'll short TCS, they'll see which amongst the Nifty is weak, and they'll short it like anything. They did it with Reliance last week. This week they're doing it with TCS and Infosys. So I don't expect them to rise up. After Thursday, you'll see it'll rise up. It'll recover because they lose a lot of money, isn't it? So they short it and they get whatever they have over here, and by the shorting also they make money. So institutions are champions over here. They make the, I mean, when Zerodha guy, I mean, Nitin Kamath said that 95% of retail investors do not make money. That means 5% of the people who are over here, they make money, and they make a huge amount of money. Right. And it's evident. I mean, like today, for example, I'll show you my positions. So I put in 6 lakh rupees. I made a profit of 10 lakh. Although I was stupid at the morning. I was playing around with it. I already made 10,000 rupees in it. And my option that I have sold, this should give me 51. 1 second. Okay, this is strange. Okay, okay, this was supposed to be 38, but okay, it's counting today's gain as well. Sorry. So this is supposed to give me this amount of money for a 6.2. So this is like 10% itself. So 8% profit, so something like that. Just a second. Why does it look so weird number? I'm not sure. Sometimes this happens. But there's huge risk. I mean, for example, today morning itself, it was at this position. So this is from yesterday's. I was trying to strategize because Nifty was at this point yesterday. It was at, I think, to expand this one. Okay, I can't. Nifty was at, I think, where was it? 17 something, 17,400, 17,465. Today it went down to 17,300, and right now I think it's at 17,460, somewhere over here. If
Right.
it falls in the next few days up till this point, I'm going to lose so much money. I'm going to lose humongous amount of money, right? Almost, I think I will lose 36. I would have lost. So this is one challenge. So that's why you have to keep shifting your this thing condors, and that's why it's a full-time job. I mean, you can't look away from the screen. So
Got it.
that's one challenge. But with the iron condor, you're much more safer compared to buying calls.
Got it.
Yeah.
Got it.
So that's the idea. Next question. Any question other than that, or should I take you through the iron condor strategy? This is the strategy that I understand better. There are many other things. I mean, people play around with a lot of strategies, and they might be equally effective. But I have not. I mean, I've just started it, and iron condor has been giving me good sort of returns. It fits my risk reward profile. Second thing, options are like playing chess. Um, it's you can have multiple strategy, and one of the reason why algorithms will find it very hard to make money in options is because they can't factor in the Vega part of it. So Vega is very hard to factor in,
Vega
and
is the volatility one.
the volatility, the uncertainty of the market is something the price, the algorithms will in most cases misprice, and they might get killed. That's one of the reason. That's what I was reading also in many places. Though people try to use algorithms, but I think they use it as in a systemic manner. They don't use it like at these indicators, let's buy this, and that indicator, let's buy this, because the way your underlying it moves doesn't really impact the option pricing. I mean, it's one of the factors that impacts it. There might be so many other things,
Right.
right? Yeah. So now, okay, let's go to the condor. So I sell two sell calls. So I have a positive at this region. My break evens are 1.8 on the left hand side and 1.9 on the right hand side. Okay, and I'm just sitting on the middle, and I see that there's a lot of sell open interest over here, and some buy open interest is coming up over here. So these are put open interest. What is put open interest? These are again institutions with huge money. They expect Nifty not to go down below this point
Below
in
this
the
level.
next 2 weeks. So 17,100. They don't expect it to fall below that. So that's why they have put up their they're selling their puts over here, right? Then what do I do is now I have unlimited losses. Okay, what do I do is I hedge these losses. How do I hedge it? I buy call options. So I buy call options again, 200 points from the place where I sold the call option, and I buy another call option 200 points from where I sold the put option. Sorry, I buy a put option over here at 1700. So at 1700 I buy a put option. At 17,800 I buy a call option, and that way my risk is limited. So basically, even if Nifty, I forget everything, I miss out to get out of the trade, Nifty comes over here, the maximum that I'm going to lose is 6275 of this trade, right? So basically that's the maximum loss that I'm going to have.
So
I'm not going to
basically
have unlimited.
the call and the put that you're buying, it is to offset your short positions.
Yes, and it also reduces my profit. So if you see over here, if I didn't have that, I would have made 6% in say 9 days.
Yeah.
I would have made 6% in 9 days. By putting these two, I am going to make 8%. Okay, there's something wrong, because what happens is they take the last prices, and the moment market opens, these prices kind of change.
Okay.
So this is
so I understand. So basically, if you're increasing your safety level, obviously your max return potential will also decrease. So
correct.
that's what should logically happen.
Yeah, but the challenge with these kind of options are, if, for example, you're at today, so I'm over here, and Nifty kind of goes in the upward direction. So your volatility goes down. So this price is not going up. you are not even able to escape. So you're you have to exit at this point at 17,470.
Mhm.
Because if tomorrow also volatility falls and Nifty is going up, you're kind of stuck and you will take a loss. So in this kind of activities, taking a loss and getting out of the trade is better than carrying forward.
Mhm.
Uh, yeah, so that's the thing. But if it is going down, you might make money. The best way you can make money in option is if the option price ping pongs in some chota range over here,
Yeah.
not breaching these lines over here.
Yeah. So
So
this
that's
trade you have to carry over for 9 days or either close it out in the middle if you feel
I
it
can
going
close it out anytime.
anytime.
This,
Suppose you are in profit, you decide that okay, this is the best I can probably make, you can get out of it.
yeah, I did it today morning also.
Okay.
So the trade that I was showing you, this one, I closed it off. Actually, I made a mistake. I should have closed it off early. I was playing around with it. So what I did was I closed off my profitable one, this calls bear call spread, and I kept this open, and the market started going this side. But
Mhm.
thankfully, it came up 1%. I mean 0.2%. I sold this off and set up a new contour.
Mm.
Yeah. So that's how you can work on it. There are multiple strategies. There's this thing called iron fly, which has huge potential. So 14% if you're right, and if the condor is just at the middle. Oh, sorry, if Nifty is just at the around the middle.
Mm.
However, if you're wrong, your fall will also be very steep. People make all sorts of things, Batman and double plateau, jade lizard, all sorts of things. So yeah, it's a very interesting thing. My neighbor introduced this to me. It's borderline gambling, and also I don't know what it is.
Yeah, so
But
please give the appropriate disclaimers to all the audience, Gaurav.
yeah, this is borderline gambling. Please don't try this without understanding. If you want to try, use paper money. Use
Subject
paper.
to market risk.
Yeah,
No,
yeah, subject to huge risks. Yeah. So,
this is
and this is
huge
not a
risk.
joke. This is not a joke, Shantanu. So, this is real money. People lose money every day doing this.
Yeah,
So, be very careful. Yeah.
because see, I mean, retail investors are at the worst condition when it comes to buying or selling options. Neither they don't have the tech, they don't have the uh, connectivity. They are sitting in their home, and there's some lag between NSC and their computers, which is coming through some feedback channel. People who I mean institutions have co-located servers, so they sit right inside NSC. They can get every microsecond tick and take decisions, right? So it's very risky, I would say. But again, I mean, you know, risk to Harshad Mehta
Risk hai to
wala
ishq
dialogue.
hai, yeah. You
Yeah,
already.
yeah. I found it very interesting, but the way I'm going to use this is basically hedging, which I was trying to tell you at start. So one way is to find out what is your portfolio's beta with respect to say Nifty, and then buy a put option for Nifty, which is basically the margin of safety, right? So effectively, if say for example I bought, let's look at Nifty only. So uh, so say Nifty, you bought Nifty over here, and Nifty started falling, right? If I had a put option bought right over here, um, even though it expires, um, I would have made a large amount of money, right? And this gives me my margin of safety that Nifty is also falling down, but I'm also getting. So I'm getting a zero sum game over here. That is one of the way options are being used by institutions. So they sell. I mean, that's also one use of option, basically to hedge your risk. And probably this is the correct use of option, not the one that I was
Right.
saying.
But again, if you buy a put along with a long call, along with long Nifty, if you buy a put on Nifty, your gains will also be a little less, but you're okay with that because you're essentially trying to protect your downside.
Correct.
Right.
Exactly that. Because you don't want a downside risk, and upside, let it go. I mean, you are going to lose only 10% of the entire amount. It's like taking an insurance, right?
So 10% is generally the highest that a price goes of an underlying.
uh no, actually, if you buy it closer, so for example, when you are running a hedge fund, or you're
Yeah.
running business or something, from daily charts you get to see what is the condition, right? If your market is bearish, so
Hmm.
for example, for the last few days I knew the market would be bearish, right?
Hmm.
I had an intuition of it, and it was the case. So say for example at this point you know it is going to be bearish, you sell a put call, and for 5 days it's going to be like 3-4% of the entire cost entire money
Right.
that you would have made.
Right.
If only I had some historical data. Over here, the put call for 1 week would have been, say, 11,000 rupees, but the money that you're going to make for this downfall would be probably 500 times.
Mm, 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 mm.
Sorry, 500% or 600% in 1 week, and that
Right.
completely protects your upside capital,
Right.
which you want. So effectively, you are sitting over here, and when it starts running, it starts running. Bas. So that's
Right.
how businesses should play with option, but not the one that I'm doing. It's borderline gambling, but it's I'm enjoying the mathematics of it, because in option basically you're trading the mathematics. I have a perspective of the standard deviation of the market, how much the market will move in the next few days. There are other traders who have different deviations in their mind, and basically that's the competition that is happening. It's not at least for a neutral strategy. Yeah.
Right.
Okay.
Got it. Thanks.
So Nirvan, your question on open interest, I think one good way again is to see open interest, because if you go back couple of days back now, say, give me a good period, maybe pre-Hindenburg. Okay.
Yeah, it was. I think you want a volatile period or you want a.
Non-volatile period. So say for example, December 28, not so much volatile. You see your puts were so large and the calls were kind of less. So this was a positive period. December 29, your puts were very large. So you can see, and these are set up before, say, the expiry of that day, of
Right.
that week. So from here, you sort of get an indication what the large institutions are thinking. So if the large institutions are planning to buy, they probably buy the option and then put the, they go and purchase these things.
So if I have to interpret this chart, so you're saying the Nifty was at 18,182, is it?
Yeah, around 18,000, 200, 182, yes. On December
182. So
29, see?
right. So December 29. So looking at the big green candle at 18,000, so it basically means that institutions were taking a bet कि Nifty इसके नीचे नहीं जाएगा.
They would create support. There could be
Right.
support from other people other than the option guys, but option
Right.
guys are also pretty big.
Pretty big.
I mean,
Yeah.
yeah, if you see 4.6 million call option, money over here, $2 to $3 billion are sitting.
Right. Right.
Okay.
Yeah. Yeah. Yeah.
Over here, lesser amount of money is sitting. So they have to protect him. Now, if Nifty falls below this,
Correct.
their $2 billion is not just wiped out. The 10 billions of dollars will get wiped out.
Correct.
So,
Correct.
so rather than wiping it out, they'll push. So they'll start purchasing.
So this is a support area for Nifty.
Correct.
Right.
This is a
And
support of
resistance
Nifty.
area would be what?
This one.
18,200, is it? Yeah.
18,200. But this would be a weak resistance.
A weak
It's
resistance.
not, because you have also a
Hmm.
support. You see, you have a support.
Yeah.
And the best way to see it, how is the option changing over the day? So that would be somewhere over here. What you could do is at 9:15, or say, for example, let me take it back. So over here, you see the put at 17,400, huge amount of puts were written. Sorry, calls were written. And then people started to unwind their put positions because the underlying was going down. So people were shorting IT stocks like anything, because NASDAQ was, showed weakness. Enthusiasm for IT stocks was not there. So that's a great opportunity for institutions to even short more, right? Anybody who doesn't understand shorting? Everybody understands shorting. Good. Shorting basically means sell at higher price and buying at a lower price. So institutions were shorting at a crazy amount of level, and you see this put got unwinded, and later on again the put started pulling up, right? So somebody who had interests over here, they started pulling it up. Generally, this activity starts in Monday, Tuesday, and Wednesday, and Thursday before expiry. These 3-4 days they'll do a lot of fighting over this amount. Yeah, and then I think at the end of the day your put was, I think, in this condition, and then some amount of put started adding over here, and tomorrow more puts would be added at this part, and the market would sort of balance out over here. So the call writers will not let the market go up, and the put writers will not let the market go down.
So this is why you were telling me in the morning that looking at the OI, open interest, you're fairly confident that it's very difficult for Nifty to breach 17,400.
Yeah. Yes.
Because there's a lot of capital waiting to beat it down if it reaches 70,000.
Correct.
Okay.
Correct. Because you see from the institution point of view, they can generate alpha of 5% just by doing this. isn't it?
Hmm.
They sell their call and then they have excess capital and then they push it. They short 2 3 stocks. They short Reliance, they short HDFC Bank. Anyways, the banks are in bad condition. They short Bank Nifty, they short IT, but that's it, gone.
Hmm. So one fundamental question, Gaurav. So then, in a game which is rigged so much in favor of institutions,
Hmm.
why would retail guys want to participate in it?
Two reasons. Retail guys, there's a lot of influence from influencers,
Yeah.
right?
So
Right.
I'm talking about somebody who is knowledgeable, somebody who has studied options
Huh,
and all of that. So
huh,
why would somebody like that, for
huh,
example, your neighbor, why,
huh.
or maybe even you're trying your hand at it. So
Hmm.
I'm saying that from what you're describing, institutions have a disproportionate impact or a way of manipulating this market. So
Hmm.
then what is the extra benefit or alpha? How can a good educated retail guy generate alpha here?
See, if you are like Rahul Dravid, right,
Hmm.
you stand just behind the institution. So institutions are standing over here, they are making a 5% killing. You stand over here, you make a 2% killing. But 2% killing for 52 weeks is 100%,
Hmm.
right?
Hmm. Hmm.
So that's what you do.
Okay. So
You
basically,
stand
you
behind.
track open interest and you don't basically take bets against institutions, is what
No,
you're
no, no,
saying.
never, never.
Yeah. Yeah.
Stay behind them and try to do slowly. Play
Right.
it slowly. That's the main fundamental thing. You can also make money from institutions. It's not like all. I mean, see, markets again are a balance of people who are pessimists and optimists, right?
Yeah.
So over here also, people writing puts, people writing calls. If you're over here, there's some luck factor also, and you can make money over here. But it's very. I mean, sometimes because of violent moves, suddenly what would happen is once a large institution has made their thing, what they'll do is they'll unwind their call positions and they'll start pumping money. They'll start pumping money in the opposite direction. They'll buy puts and then they'll start pumping money. And when that happens, if you're standing over here, you might get beaten down. So keeping a good margin of safety is good. I mean, that's why I try to put myself at one standard deviation. So Nifty is very hard to manipulate. I mean, you will need an enormous amount of capital to do that. But
Right.
yeah, but sometimes that does take place. I mean, it's
Right. So
even
this is like you said, it's a full-time job. You have to be on the screen every minute of when market is
or
open.
or at least set up alerts and all.
Yeah. Yeah.
So
Right.
for me, it's not one standard deviation because I had to readjust this one today morning. But in case it goes somewhere over here, I'm going to exit. So I take a loss and
Hmm.
exit. It's not great loss. It's just little loss, but I'll
But
just
why is
exit.
it a loss? It's still in profits, right?
No, because today's booked profit is showing up over
Okay.
here.
Okay. Okay.
So today's booked profit was 10,000, and this one would be a loss.
Okay.
Yeah.
Okay.
So basically, it depends on your risk reward profile. I mean, if you are not taking enormous amount of risk and not trying to squeeze every juice out of the system, you probably will sail safe. The
Mhm.
thing that I tried with my virtual currency, I sailed safe because I was not trying to pull out all the juice. So if tomorrow morning, because of this, it looks skewed, but today's actually unrealized profit is 2,000 rupees, which carries over tomorrow. And I have a decay of 8,000. So tomorrow morning, I will have 10,000. Today 10,000,
Mhm.
tomorrow 10,000. Okay. If
Mhm.
Nifty stays over here, I'm going to keep the position. If Nifty goes a little bit here, I'm going to exit and go out
Got
and
it.
set up for next week again.
So you're done till 9th March. You're not basically then.
No,
I
this is
mean,
2nd March. This is 2nd March.
okay. These are
Then
2nd March. Okay.
then
Okay.
I'll put up for 9th March.
Got it. Got it. So how many expiry dates are you playing normally?
I play only two. I mean,
Only two. The
current
near week
expiry and the next
and the
next.
next one. Okay.
But I'm trying to play the near week because this next week is becoming a little challenging because of this. I mean, I don't think till 2024, 2024 there would be reduction in uncertainty. This
Hmm.
Adani Hindenburg will go on, and as it
Hmm.
goes on, now we have George Soros and gang who's shorting FPIs. I mean, the
Hmm.
FPIs are net sellers in the Indian market.
Yeah.
So the rumor is that Adani and his associates are buying through offshore links. They are coming and buying Adani stock, whereas the FPIs have been selling from a long time. Actually, they have been
Hmm.
shorting for a long time because Adani's groups are buying. I mean, his brother Vinod Adani and their associates, they are buying, and general FPIs are selling. But you see a net FPI which is less, but the real FPI money that's actually outflowing out of India. That is
Yeah.
happening.
Yeah,
And
that's been the
interest rate-
case since I think August, September 2021.
Yeah, correct. Second thing is interest rates are going to stay high in US. It might increase actually. Based on that, basically you might have other
Yeah,
stuff.
further outflows. Yeah.
Further outflow. One good place is this stock market, this thing. So if you guys ever want to purchase anything and all, let me know. I will tell you what is the situation of the market. So there is this GDP number coming in 28th February. Expect volatility because of that. Uh, then also
Hmm.
these are some of the items that these are, I mean, where there are large number of what do you call it,
Right.
lightning. It's important basically.
Right.
Um, yeah, so that's the idea. I mean, expect a lot of volatility, but yeah, this is how you can play it. Yeah.
Right.
Hope
Thanks.
you understood or stuff like that.
Yeah, I had a lot of fun because I wanted to understand this, and I think I understood a little bit more. So thanks for that, Gaurav.
Okay, will you try your hand in this one?
No, I won't, because see, this is a full-time thing, and
Yeah.
I would rather that I understand it. But if I'm going to do this full-time, then I can't do equity research full-time, right? So
Yeah, you can't do it.
so
It just
I
kills
think
them.
the key is to realize, what you are going to do, and then probably leave it to experts for the remaining. So I would rather that you do this and do it really well. I would, but
Hopefully.
I would have an interest in this definitely, like, because it can also give you very important signals for your buying. Just like you said that
Yes,
you could alert us on when to buy, when to sell. I would like to learn that myself and use that in my buy decision. So yeah,
absolutely.
that is how I would sort of use.
I'll try to tell you every morning what do I think of the market. Yeah.
Sure.
So another thing, whenever you are trying to buy it after 12, if the market is bearish.
Hmm.
Because if the market is bearish, people also expect when London opens, the market will still remain bearish.
Okay. And London opens at 12,
130,
1:30. Okay.
130, I guess. Yeah.
So what is the logic
Uh,
of buying after 12 if it's going to become more bearish after 1:30?
so let me show you from the charts maybe.
Mhm.
So let me take, say, 10
I've
minute
never
chart.
opened a 15-minute chart in my life, by the way, Gaurav. So this is like the first time in my life.
All right, let's take 3 minute chart. I'm more comfortable with 3 minute chart.
Wow. Okay.
3 minute chart. Let's Guys, if you want to drop off, please drop off. We are just talking all gambling stuff. Okay. So you see, there's been a little bit of what do you call it? Some amount of resistance. I mean, some amount of
Hmm.
fighting that has been happening. Then at 11:50, it starts falling. Then London opens at, say, for example, 1:30. Around 1:30, this region, it starts climbing up. Okay, this is for
Hmm.
today. Let's
Hmm.
take another day. This is also a bearish day. Sometimes it doesn't have that trend, but you see, it was generally bearish and it became bearish, more and more
Right.
bearish
Right.
till 12, and then 12 it opened, and then again whatever was the trend.
Hmm.
If you look at maybe over here, 12. So this day I was trading. So at around 1, it started becoming a bit bearish. Generally, I've seen, I mean, this is from my experience. I've not actually tried to time it on anything, but around this time, it starts to fall a bit. I wanted to show you a flat market. Let me try to find a flat market. Maybe I'll also get a good.
Hmm.
So this market is pretty flat. So at 12:30, yeah. See, generally, see, from 10:30, it's generally flattish, and then around 12 it starts falling, and then after that, again, once London opens, things go a little bit here and there.
Okay.
Yeah,
Got
so
it.
you can check it. I mean, check it out
Yeah.
in multiple areas.
Yeah.
See, at 12 it started, I mean, this region, it's flat, then it
Hmm.
fell, and then
Hmm.
it climbed and fell and all.
Got it.
Yeah.
Interesting.
So that's the trend mostly, but not every day. If the mood is bearish, if the mood is bullish, nothing happens at that time.
Right. Got it.
All right. Any questions from anyone? Okay. Okay, then we can close, I guess.
Yeah. Thanks. Thank you for the session, Gaurav. I mean, I know it was very different from the